It's a little before 10, but you guys are just waiting patiently. So good morning, everyone, and welcome to the Ncra board meeting. I call this meeting of the Ncra board to order. But before I call the first item this morning on our agenda, I would like to acknowledge a group from the Heartland Credit Union Association who are joining us all today. Welcome to all of you. We are delighted to have you here. Can you at least stand so we can recognize you and welcome you? Oh my, what a group. I don't know if anyone is left in the Heartland. So great, thank you. Thank you all again. We are delighted that you're here. You honor us this morning with your presence. The first item on our agenda today is Final Rule Part 701, Public Unit and Non-Member Shares. Staff presenting Larry Fazio, Director, Office of Examination and Insurance, Tom Fay, Director, Capital Markets Division, and Ariel Perea, Staff Attorney, Office of General Counsel. Good morning.
Good morning.
Good morning. And welcome.
Thank you and good morning. We're here to present the final rule updating section 701.32 of the Ncaa regulations related to shares from public units and non-members. This, excuse me, this rule update was initially outlined in the Regulatory Reform Task Force agenda as a way to provide regulatory relief to credit unions by aligning the authority to accept public unit and non-member shares with the credit union's authority to borrow. Public unit and non-member shares or deposits share many of the same characteristics as member shares and borrowings. When used responsibly, these can be a beneficial source of funding for credit unions, especially smaller ones. Now I'll turn it over to Ariel, who will discuss the changes to the final rule.
Thank you, Larry. Slide 2 compares the May 23rd, 2019 proposed rule with the final rule that's under consideration by the board. The first column of the table summarizes the key elements of the proposed rule, while the second column shows the changes made by the final rule. As is readily apparent, the final rule is identical to the proposed rule, with the exception that the aggregate limit is now the greater of either 50% of paid-in and unimpaired capital and surplus, or $3 million. The $3 million alternative is found in the current regulations, but was proposed to be removed. The proposed rule specifically, however, sought comments on whether or not to retain this alternative limit. Turning to the third slide, we wanted to briefly describe the shares that will count towards the new 50% limit. As initial matter, we just wanted to note that consistent with the proposed rule, the regulatory changes will apply to all federally insured credit unions, including low-income credit unions. The final rule amends section 701.32 that is applicable to federal credit unions. The final rule also makes a conforming change to section 741.204, which applies this regulation to federally insured state-chartered credit unions. Federal credit unions are statutorily limited to receiving non-member shares from two sources only, non-member public units and non-member credit unions. Like Hughes, on the other hand, may accept shares from any non-member. As the chart indicates, the limit applies to all non-member shares regardless of the source. Further, the regulatory 50% limit applies to all shares from public units, even if the public unit is a member. The limit does not apply to shares received from any other members. Now I will turn it over to Tom, who will discuss some of the characteristics and statistics related to the rule.
Thank you, Ariel. So Ariel had discussed in the prior slide what shares are included as part of this proposed final rule and when permissible to a particular credit union. An important factor to consider, however, is that the permissibility of what shares a credit union can accept shouldn't be confused with whether the shares are sourced either directly or through a third party. We call this the method, which is the middle column, as you can see on the slide. Depending on the situation, credit unions use a listing service or may use a listing service or a broker to gain access for funding from interested investors. Both of these services involve third parties that act as a marketplace between issuers and investors. By and large, the majority of credit unions are still direct deposits from members. Both sources, however, are permissible. So regardless of the method used to receive shares, we know that credit unions may use one or both of these forms of funding successfully to achieve strategic mission and balance sheet management objectives. The overall diversity, cost, source, insurability, and the operational burden are key factors in the decision-making on how credit unions fund their business. So on slide 5, I'd like to make 3 key points. Number 1, looking at the chart on the left, the total amount of public unit and non-member shares for all credit unions as of June 2019 was $16 billion, or 1% of the industry's total assets. You can see the components consisting of non-member deposits at $11 billion. Next up, member public unit at $3 billion, and lastly on top for non-member public unit at $2 billion. All numbers rounded, by the way. That's my first point. Point number 2, the chart on the right shows how credit unions fund their operations expressed as a percentage of assets. As you can see, member shares and equity represent 94% of the total funding for the industry. The public unit non-member balance fits into a broader funding mix utilized by credit unions, but only represents 1% of assets today. And the third point I'd like to make with this slide, the 2 slices of the pie that are pulled out, as you can see, the public unit non-member and the borrowings, include collectively are only 4% of all asset funding. However, it is these 2 pieces where we will now see a consistent framework for funding operations and regulatory limits. And then lastly, on slide 6, as already noted, credit unions will be subject to similar regulatory limits on the sources of funding related to public unit non-member and borrowings. However, there's a practical limit on the amount of funding credit unions can obtain before their net worth ratio would decline below 7%, the level necessary to be well capitalized for PCA purposes. Looking at credit unions on a consolidated basis, as reflected in this slide, the new rule would allow the industry to increase its total funding capacity from these 2 sources, from the existing 56% in the current rule to 65% in the final rule. To take advantage of the higher limit, a credit union would need a net worth ratio of approximately 16%. While this final rule will not materially change the amount of public unit or non-member shares and borrowings that credit unions use to fund their operations, the increase in the aggregate limit will provide eligible credit unions with additional flexibility in managing their liquidity needs and potentially providing increased amounts of reasonably priced funding. Now, I will turn it back to Larry to conclude our presentation.
Thank you, Tom. So as Tom outlined, most credit will be constrained by the amount of leverage they can engage in based on their net worth ratios. Generally, it is small credit unions that have net worth ratios high enough to take full advantage of the proposed new authority. So while this final rule would provide relief to all credit unions and give them more flexibility in managing where they're getting their funding from, the type of funding they're using, it would likely benefit small and low-income designated credits the most. Additionally, even without the waiver provision, most credit unions will have more authority under the new rule than under waivers that have historically been approved. Through the examination and supervision process, the Ncua will continue to review a credit union's funding structure and characteristics to ensure they are consistent with the credit strategic plan and do not pose a safety and soundness concern. So in summary, we believe this final rule would provide responsible regulatory relief without posing undue risk to the share insurance fund or credit unions. That concludes our prepared remarks, and we'll be glad to answer any questions you have.
Great. Well, thank you, gentlemen, for your presentation this morning. I certainly appreciate the hard work that went into producing this final rule. I also appreciate the work done by staff to study and synthesize the public comments we received on the proposed rule. Stakeholder comments are a very important part of Ncua's rulemaking process, and we consider each comment judiciously before finalizing a rule. This rule was no different. For the public unit and non-member final rule, we listened to these concerns and in response retained the alternative $3 million limit. I appreciate the way we have the opportunity to finalize this rule as identified in our regulatory reform agenda and deliver on the goals of extending responsible regulatory relief and giving greater flexibility to eligible credit unions to determine the funding structure most appropriate to support their operations. It is important to note that this is accomplished without requiring a waiver from the Ncua. This rule will also allow the agency to think about balance sheet management and funding sources in a more holistic manner. As a result, examiners will look at funding strategies through a broader lens and assess the overall risk associated with a credit union's funding structure and the corresponding risk management practices needed, instead of just looking at individual funding sources in isolation. This final rule represents a great opportunity to streamline our regulatory requirements without introducing undue risk. Setting a higher but prudent limit on the amount of public unit and non-member shares will eliminate the need for credit unions to seek a waiver of the limit, as they must currently do. This will save both credit unions and regional offices valuable time and resources and allow them to refocus on more critical work needed to keep our credit union system safe. With this action this morning, we will eliminate onerous paperwork while enhancing safety and soundness. While this final rule will indeed expand the authority for which credit unions can accept public unit and non-member shares, most credit unions will be constrained in the amount of leverage they can add to their balance sheets based on their respective levels of net worth. Many small credit unions have net worth levels high enough to take full advantage of this new authority. So while this proposed rule would provide relief to all credit unions, its benefit would be mostly felt by small and low-income designated credit unions. The credit union industry has enjoyed solid share growth, a reflection of their financial strength and the high-quality services they provide. Loan growth over the last several years has been very strong, also reflecting the value of credit unions to members and consistently outpace share growth. However, this trend can in fact create liquidity risk for some credit unions. Our supervisory efforts will continue to focus on liquidity strength and include a more holistic view of credit unions' funding strategies, and this includes those utilizing public unit and non-member shares as part of the mix. This is, in part, why we this morning finalized this rule with a requirement for a written plan if a credit union exceeds a combined 70% of paid-in and unimpaired capital and surplus for public unit, non-member deposits, and borrowings collectively. In summary, I believe this proposed rule will provide responsible regulatory relief without posing undue risk to the Share Insurance Fund. Thank you again, gentlemen, for all your work in bringing this forward for today's board action, and I will definitely be supporting it. But I do have a few questions. First, this final rule reinstates the existing rule's $3 million de minimis alternative limit. I understand we did so in response to public comments. Can you all once again summarize the upshot of those comments and why they wanted to keep this provision?
Certainly, Mr. Chairman. Ncua received 17 public comments on the proposed rule. The large majority of them, 14 to be exact, were from either credit unions or from the representative organizations. Almost all of these comments advocated retaining the alternative limit. The commenters expressed concerns about the potential negative impacts of getting rid of the limit. In particular, they were concerned about the impacts on small credit unions, for which 50% might not be a substantial amount. They also expressed concerns about on the effects on like-yous, who might rely on non-member shares for a lot of their funding, and also on newly chartered credit unions, who might not have had enough time to become adequately capitalized. So these are all strong arguments in favor of retaining the alternative limit. It's something that we had contemplated. We had asked for comment specifically in the proposed rule, and so the decision was made to retain it in this final rule.
Great, thank you. And as everyone knows, we certainly take those comments seriously, and we do look at each and every one. So please, you all, whenever we ask for comments, please do send them. We really do want to glean insight from the feedback you provide. Of course, you all, we have an incumbent responsibility to supervise how credit unions will employ this funding flexibility. What change, if any, can credit unions expect from Ncua examiners as we look at their funding strategies and liquidity risk in this area?
Sure. Thank you, Chairman, for the question. I think the changes will be subtle at best. The agency adopted a liquidity rule back in 2014, as you know, 741.12, which essentially is a strong framework for our liquidity procedures. And so a lot of it rests on that foundation in terms of, a credit union having on-balance sheet liquidity, access to the marketplace, and of course a contingent funding plan.
Exactly.
So without that bedrock, which is essentially what we're built on, I think changes will always come in a way of improved supervision procedures. But I don't think you're going to see anything significant in terms of how we supervise here.
Great, thank you. And I do have one final question, and that is just under the existing rule, credit unions must seek a waiver to go above the limit set forth in the regulation. And some waivers do, in fact, I understand, remain outstanding today. So how will Ncra manage the transition to the new rule and treat such existing waivers?
Thank you again. I'll take that question. The new limits will supersede and for the most part do away with any waivers that we have out there. So the headroom we've built with the new limit is ample enough to support the waivers that were previously approved. We do have two credit unions that we'll need to work with in terms of just coming into compliance on the new limits, and we've already been in touch with our regional supervision on that, and so there is efforts to monitor that.
Great.
So.
Well, thank you. And I look at that reduction in waivers as another effort to provide a modicum of regulatory relief and reducing regulatory burden. So thank you all. I have no further questions. Board Member Harper.
Thank you, Chairman Hood. And you actually anticipated in your last question one of my questions. Okay. I was eager to know that, and I won't be asking that question, but I do want to thank you, Larry, Tom, and Ariel, for your presentation today and for incorporating the requested changes that I made to the text of this document. The final rule will provide federally insured credit unions with a greater balance between external funding sources and borrowings. As such, it would better enable these institutions to seek more reasonably priced funding options. In its comment letter on the proposed rule, the National Association of State Credit Union Supervisors similarly noted that, quote, providing credit unions greater operational flexibility to utilize external funding for liquidity makes sense from a regulatory perspective, unquote. I agree that greater access to such funds enhances credit union liquidity options and preserves other lines of credit. In getting into the field around the country during the last 6 months, I've spoken directly with many credit union leaders. Through those conversations, I've gained a greater appreciation of how important public unit and non-member share deposits are to some credit unions. When prudently managed, these funds allow credit unions to increase lending and better serve their members by meeting loan demand. One conversation with a credit union in the Pacific Northwest brought this point home to me. The credit union has a high demand for the specialized loans that it offers to small business owners and which few other lenders have expertise to provide. But with less than $100 million in assets, the credit union has limited resources to match that loan demand. So the credit union has turned to non-member share deposits. Those funds have allowed the credit union to increase lending and improve the livelihoods of its members, create jobs, and strengthen the local economy. And as one commenter on this rulemaking also noted, in recent years, federally insured credit unions that have employed non-member deposits have tended to be more active lenders and therefore achieved higher earnings on average than their peers. That is a good thing in my view. Additionally, I'm especially pleased that this final rule will retain the alternative $3 million limit for public unit and non-member share deposits. I raised this point during consideration of the proposed rule. Small credit unions, and particularly newly chartered credit unions, which haven't yet had the time to become adequately capitalized, will benefit from the flexibility provided by keeping this limit. Before yielding back, I do have several questions. Would you turn to slide 4? Larry, one criticism that I have often heard about this rulemaking is that it will permit an increase in high-cost brokered deposits, which has resulted in problems for insured depositories in the past. We've discussed this issue, and I think it would be helpful to shine some light on this matter for the group before us today. Would you explain why increasing the access of credit unions to non-member and public shared deposits is not the same as brokered deposits?
Yes, and as Tom had indicated when he reviewed this slide, how the method of how they get sourced isn't synonymous with the nature of the account. So just because they're public unit and non-member shares / deposits doesn't mean they're automatically broken deposits. That's a separate choice a credit union would make as to how they're going to bring in those shares. And in fact, in many cases, the credits that are currently using this authority, they're sourcing it directly. They're not going through brokers. And so those two, the type of account and the sourcing of it should not be conflated automatically, and that's not have been our experience that they've used the current authority that way in terms of the method of.
And Larry, at least in my mind, you could have either a brokered deposit or an unbrokered deposit, and it could still be at a high interest rate, or at least a higher than average interest rate for the marketplace. What safety and soundness guardrails will be in place to ensure that credit unions aren't paying out unrealistically high rates on these non-member and public share deposits? Public unit, I'm sorry.
And just to kind of continue with that, the prior thought into this thought, credit unions can use different methods to source all of their deposits, whether they are traditional member deposits or public unit and non-member deposits. And so that method exists across all types of deposits. The other issue of what's the cost of those deposits and what are the terms. They have a lot of flexibility both on the member deposit side as well as on the non-member deposit side in terms of how they price them and the terms and conditions of those accounts. And so they're also not synonymous with high-cost deposits, and so we should also draw that distinction that, in fact, in many cases, especially like Q's, they're getting these at very attractive rates because the investors, the depositors have some other reason they want to help that credit union with their fund. So they're not necessarily looking for a high rate of return, the investor. So again, it's not automatically the case that these are high cost deposits. In fact, in many cases, that's not the case. So what we need to think about, and the chairman mentioned this in his remarks, what we need to think about in terms of examining credit unions is whether it's a traditional member deposit or it's a public unit or non-member deposit, what are the terms and conditions of those accounts? Are they sensible? Can the credit union afford them? Do they fit in the credit union's overall asset liability mix? Does it make sense from an earnings standpoint? As Tom articulated in his opening remarks, those are the types of things we need to think about and not so much focus on the definitional distinction between the two, but it's really about the substance of those accounts in terms of the terms and conditions.
I very much appreciate that answer. Edwin, would you mind moving to slide 5? Another comment letter on this rulemaking noted that system-wide non-member deposits had increased fourfold in the last 5 years, from about $3 billion to more than $12 billion. And as this slide shows, is that as of the end of the second quarter, it had reached a total of about $16 billion total. Larry and Tom, what's driving this increase, and how might this final rule alter this trend, if at all?
Well, so I'll start and you can jump in if you want. A couple of things. We have a lot more low-income designated credits than we used to have. As you know, we've had a significant increase over the last 10 years or so in the number of credit unions that are low-income designated. So more credit unions now under the law have access to non-member accounts, deposits from non-members. The other trend that we think that's driving this is, as the chairman had indicated, we've seen over the last 5 years in particular, while we've seen very strong share growth, we've seen even stronger loan growth in the credit union system. And so if over a 5-year period loan growth consistently outpaces share growth, that means credit unions are generally drawing down their available balance sheet liquidity to fund those loans, right? Because they don't have as much money coming in as they have going out in loans. And so we've seen an increase in the loan to asset ratio and a shrinkage in the available on balance sheet liquidity ratio. And so if you're a financial institution, you're looking at a certain level of liquidity you want to manage to, and you don't want to go below. And so you start to think about the funding side of the balance sheet. And so maybe some of these institutions have said, oh, I've got this flexibility for this other source, and I'm going to use that to maintain my liquidity.
And how might this final rule change what those trends you just described happening? How is that going to change going forward, do you think?
I think the biggest, and again, if we, both in terms of this slide and if we go to slide 6. So it's not, this rule is not a sea change in the total amount of leverage that credit unions can do. It's really only going from a full maxed out limit of 56 to 65%. But it does give them a lot more flexibility in terms of, are they using the public unit and non-member shares, or are they using borrowings? Because under the current regulatory requirements, public unit non-member are 20%, limited to 20% without a waiver, whereas borrowings then go to the full 50. So it really gives them more flexibility about where they get the funding from, not necessarily a whole lot more flexibility in total between both. And so I think what you'll see is credit unions thinking at the core more about, well, what makes the most sense given in my situation? For my needs, maybe a borrowing makes more sense, or in another set of needs, maybe using public unit non-member shares is the cheaper, better way to go. That flexibility, I think, will pay significant dividends for credit unions in terms of exactly where it's coming from, but it's not necessarily a whole lot more in total.
Got it. Thank you, Larry. We put the rule that is currently in place about 31 years ago, and it was in response to some crises. Larry or Tom, how has asset liability management changed in the last 31 years since this rule was previously considered? And what tools and regulatory requirements are now in place to allow credit unions to prudently manage their operations?
Sure. I don't know about the 31 years, but I'll take a go at it.
I was in college 31 years ago, so maybe let Tom take
No,
that.
I think, obviously what's happened in the industry is, credit unions really have significantly progressed in their modeling and ALM capabilities. So you have third-party services and technology platforms out there that are just fantastic tools and very affordable. So I think, that whole side of the world has lifted. The tools are there. Credit unions are now modeling more than ever, providing great scenario analysis. It's almost become standard operating procedure now. What we didn't ever think it was. Now you have economic value analysis and stress case scenarios. So all of these things, provide us, with a better way to look at credit unions, and the transparency around that risk has significantly changed, right?
Yeah.
Where we may not have understood the risk, now it's fairly transparent, and we're asking questions not about the results, but their assumptions and the scenarios they use, which is a significant lift in our supervision.
So those who would make the argument that the sky is falling down by changing this rule are not necessarily recognized as the changes that have happened in the last 31 years.
At least that, yes.
Okay, thank you, Tom. It's very good to hear that credit unions have become more sophisticated in asset liability management. When coupled with the guardrails contained in the final rule and the supervisory approach we will take going forward to ensure that credit unions use these sources of funds consistent with prudent risk management principles, this public unit and non-member share deposits final rule will provide all credit unions, and especially credit unions, small credit unions, with greater flexibility in their funding to better serve their members. As staff have previously noted, such flexibility will enhance liquidity and the safety and soundness of individual credit unions and the system as a whole. Accordingly, I will support this rule.
Thank you. Board Member McWaters.
Thank you, Mr. Chair. Following up on the questions of my two colleagues, I just want to talk about risk for a second. We go to slide 5. Just looking at a balance sheet, you have a left-hand side of the balance sheet and a right-hand side of the balance sheet. And public unit non-member deposits are 1% of assets. Is that 1% a today number under the current rule? Okay, what do we expect it would go to under this proposed rule?
We're not really sure.
I mean, you're going to go to 27%? Is it going to go to 1.3%? Give me a framework here.
Yeah, I think, if you look at history, traditionally credit unions have had a strong membership funding base. So does that change? Because there's other forces that are going to create this dynamic if it ever does happen. Do we have a recession? Do we have some other causes where credit unions would have to resort to alternative funding? So I don't think the public unit non-member space will ever really blow up in terms of its size. But however, if you look at balance sheets holistically, we're prepared for that because that's what our liquidity rule does and that's what our supervision does. We can almost be indifferent as to how they fund. We just want to know what their funding policy is and how they balance all those funding tools as part of their strategy.
Okay, and let me just add additional context to that. Right now, under the current limit, they could do 20% without a waiver.
Right.
So if they were really right now want to max out, that wouldn't be 1%; it would be 20. So even with the current authority, they're not using a whole lot of it. So I think the bigger, I wouldn't expect under this rule that purple line to become a really big number, the purple part of the pie. What I might expect though is more interplay between the red slice borrowings and the paid and unimpaired, or the public unit non-member deposit slice. And you might see more movement in between those categories. For those institutions where they do need a fair amount of leverage because of liquidity needs, you might see some shifting away from borrowings, which has more headroom currently, into some of these public unit and non-member shares. But as a system as a whole, I wouldn't expect to see those two slices of the pie materially increase necessarily.
Okay, that's very helpful. What's riskier, public unit non-member deposits or regular deposits?
Depends.
Depends on what?
Depends on a lot of things. It basically comes back to...
Just give me 14 or 15.
14 or 15. So I think the simplest way to think about it is you can do very sensible and prudent and safe things with member deposits, and you can do very prudent and sensible and safe things with public unit and non-member deposits, and you can also do very reckless things with both. And so what it really comes down to is terms and conditions, the pricing of those accounts, how they're approaching them, and how they fit within their overall asset liability management structure. So this goes back to us thinking about the funding holistically and really peeling away the layers of the onion through the exam and supervision process to see what exactly are they doing with those accounts. Are they getting high-priced hot money and they're maybe getting it through brokers, or no, they're using this authority very sensibly. It's very affordable funding. It's very stable funding, regardless of the label of member versus non-member. And so it all depends on exactly what's going on in all of that pie, not necessarily one versus the other.
Okay, so credit unions have the regulatory flexibility to structure a balance sheet within certain parameters that we examine and supervise for.
Correct.
Okay, thank you. Let's go to the right-hand side of the balance sheet, and that is slide 6. And we look at balance sheet leverage. What the box on the left, can someone explain that in a little more detail about what does this actually mean to enhance the leverage by this rule and the safety and soundness issue that could be presented with enhanced leverage?
Sure, I'll start. Thank you for the question. So essentially what the chart does is if you were to simulate or create a scenario where every credit union maximized their potential under the two regulatory limits for non-member and for borrowings, their balance sheets could grow by 56%. Now, that's significant. Of course, they would have to do it responsibly under our safety and soundness framework. So, but the point of this is that the new rule, while it only increases marginally the amount that they can do, okay, it does provide them with the flexibility now because we've created a single, essentially regulatory framework for both limits. So Again, we don't see this as a safety and soundness concern because we're looking holistically at the whole funding strategy. Are you using borrowings? Are you using non-member? What is your membership like? And so all of these things are, and essentially, again, the point of the chart is not a huge increase in leverage, but the flexibility is our key.
Okay.
Key point on this one.
Go ahead.
I would just add to that when we think about a credit union and their growth strategy, right? You think of leverage, you're usually doing that for to generate growth. And of course, as a general rule, credit unions are very focused. If you go back to the pie chart, they're largely focused on the core member sort of organic deposit base, right? These forms might be a little bit less organic, but not necessarily completely inorganic, so to speak. So it's why are you growing? How fast are you growing? Can your capital support that growth strategy? And ultimately, on the other side of the balance sheet, to your point, the two sides of the balance sheet, what are you doing with this money? So if you're taking in this money to grow, you've got the funds coming in, you're paying a certain rate of return on that, and that goes back to, is it a high-cost, volatile deposit, or is it a stable, affordable deposit, or borrowings, or what have you? But what are you doing with the money? If you're using it to meet current liquidity needs, that's one thing. If you're using it to fuel a particular loan program, or you want to do some investing with that, well, then what's the efficacy of that strategy? Are they making good quality loans? Is it sensible what they're doing? Are they making high quality and safe investments, or are they doing something reckless with that money? Are they funding ill-advised high risk loans? Are they buying bad investments? That sort of thing. So that's part of the overall balance sheet, asset liability management and strategic planning process that we have to look at. Of if you're using these authorities to grow, what are you doing with it?
Okay. So in a nutshell, looking at the left-hand side of the balance sheet, the asset side, the right-hand side, the leverage side, this new rule, given our ongoing examination and supervisory protocols, does not create a safety and soundness issue. That's a question.
Correct.
Okay. Thank you.
Great. Thank you all, especially for a very robust conversation this morning. Is there a motion?
I move that the board approve final rule part 701 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye. Aye. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. Thank you again, gentlemen.
Thank you.
Thank you.
The second item on our agenda this morning is the Notice of Public Rulemaking, Part 701, Appendix B, Chartering and Field of Membership. Staff presenting Ian Marina, Associate General Counsel, Jeff Zick, Trial Attorney, and Marvin Shaw, Staff Attorney, Office of General Counsel. Good morning, gentlemen.
Good morning.
Good morning.
We're here to present a proposed rule to amend the NCUA's Chartering and Field of Membership Manual. This proposed rule relates to a 2016 final rule that the board issued. Therefore, I'll provide some history before detailing the proposed rule in order to give some context. In October 2016, following up on a November 2015 proposed rule, the board issued a final rule to amend various provisions of the Chartering and Field of Membership Manual. For ease of reference and to help orient everybody, I'll refer to that final rule as FOM1. FOM1 made various changes to the Field of Membership Manual. Most significantly for our purposes today, it changed several provisions for the community field of membership options. I'm going to detail 4 changes that were made by FOM1 that are most relevant. First, FOM1 eliminated the requirement for a federal credit union that serves a core-based statistical area to serve the core of that area. A core-based statistical area is a geographic area designated by the U.S. Office of Management and Budget, which reflects commuting interactions within a particular area. The second element of FOM1 that I wanted to highlight was to allow federal credit unions to serve a combined statistical area or a portion of such an area, subject to a limit of 2.5 million people within that geographic area. A combined statistical area simply combines multiple core-based statistical areas, also recognized by the Office of Management and Budget. The third change was what we call the adjacent area option, which permits a federal credit union to submit a narrative to the Ncua to support adding a bordering area to an existing well-defined local community. The fourth change that I'd like to detail was to the rural district option, which is to increase the population limit from 250,000 to 1 million. Shortly after the board issued the FOM1 final rule, the American Bankers Association filed a lawsuit in federal district court in DC to challenge all four provisions that I just detailed. The court issued its decision in March 2018. It upheld the core area service requirement removal provision that I discussed. It also upheld the adjacent area option that I mentioned. However, the court invalidated the combined statistical area definition and also invalidated the increase in the rural district population limit. Both sides appealed this ruling. The Ncua appealed the combined statistical area and rural district rulings. The ABA appealed only the core area service requirement removal provision. It did not appeal the adjacent area provision, which leaves that provision intact and in effect in the chartering manual. Coming to more recent events, the DC Circuit Court of Appeals in August of this year issued its decision on that appeal. It ruled in favor of the Ncua on combined statistical areas and rural districts, finding that those provisions were reasonable and consistent with the Ncua's Organic Program Statute, the Federal Credit Union Act, as well as the Administrative Procedure Act. The court also found that removing the core area service requirement for core-based statistical areas was consistent with the Federal Credit Union Act. However, the court ordered the matter to be remanded to the Ncua to provide further explanation of the provision to remove this requirement in light of a concern for the potential for federal credit unions to engage in what the court termed gerrymandering or redlining in the selection of the field of membership to avoid serving certain populations. So that all brings us to today's proposed rule, which has three main components. It is designed to comply with the court's directive to provide further explanation and is also consistent with the court's expectation as stated in its opinion that the agency should act expeditiously to provide this further explanation. The first component is to propose to reinstate the combined statistical area definition as was found in the FOM1 final rule in 2016. Second, the proposed rule provides further explanation with additional reasoning and factual support for the elimination of the core area service requirement for core-based statistical areas. This includes further reasoning, explanation, and examples which demonstrate that removing this requirement may better enable federal credit unions to serve low and moderate income individuals who may often reside outside of the core areas within a core-based statistical area. The proposed rule also discusses that removing this requirement may also provide enhanced flexibility to federal credit unions that may have limited resources to serve a larger area, and this may better enable them to serve a more compact area consistent with their resources. And finally, the third component is a proposed new element in the chartering field of membership manual, which would build upon existing processes related to an applicant's business and marketing plan. This process would require a federal credit union choosing to serve a combined statistical area or a core-based statistical area to submit an explanation and support for the choice of its field of membership and how it will serve low and moderate income individuals. This provision would also provide the Ncua with express authority to follow up on these submissions, require further information as it deems appropriate, and if necessary, reject the application if it determines that the selection of the field of membership is based on discrimination. These are the three key components of the proposed rule. It also includes a request for public comments and a 30-day comment period. This concludes our presentation. We're happy to address any questions you may have.
Great. Thank you, Ian. I am delighted that the board is considering this morning's proposed rule. This proposed rule marks an important stage in the NCUA's longstanding effort to modernize the community field of membership rules for federal credit unions. As I have said before, I intend for the Ncra to take a phased approach to implementing the August 20th, 2019 decision from the DC Circuit Court of Appeals. Today, with this proposed rule, the board is taking a critical step in the NCUA's ongoing work to allow credit unions to alleviate some of the difficulties of low-income and underserved Americans in gaining access to financial services. often called financial inclusion the civil rights issue of my generation. And this proposed rule will help maintain and expand financial access to more Americans. As you, Ian, mentioned in your presentation, this important work dates back to 2015 and 2016 when the board issued the rule referred to as FOM1. Shortly after this rule became final, the rule faced an immediate legal challenge. I was delighted that the D.C. Circuit Court of Appeals upheld key parts of FOM1 in August of 2019. As I announced shortly after that decision, I believe it is important for Ncaa to take the phased approach and to provide guidance so all credit unions can begin to expeditiously implement the court's decision. Let me highlight some of the key actions we have already accomplished and how today's proposed rule will help us achieve even more progress. As I announced in September, federal credit unions may submit applications seeking expanded rural districts serving geographic regions that encompass up to 1 million people and that meet the other requirements set forth in the agency's field of membership rules. The Ncra will act on such applications at the appropriate time. Today, with this new proposed rule, the board is proposing to reinstate the combined statistical area option from FOM1 in light of the D.C. Circuit Court's favorable decision. With this proposed rule, the board is also complying with the D.C. Circuit's expectation that the agency act expeditiously to provide further explanation for FOM1's elimination of the core area service requirement for core-based statistical areas. These are all somewhat technical features of the NCUA's chartering and field of membership rules, but they are so important because they reflect two very key objectives. One, increasing access to financial services for people of modest means, whether in rural or heavily populated areas. And secondly, providing greater choice and flexibility for consumers and federal credit unions. I believe this proposed rule will help achieve both of those goals. And let me pause for a moment to emphasize that I take access to financial services very seriously. And therefore, I am pleased that this proposed rule will clarify and enhance the agency's authority to address potential discrimination in the chartering process. So now I have a few questions. First, I understand the field of membership litigation is ongoing. Can you point to any dates or milestones for me, please?
Sure. Thank you, Mr. Chairman. There is a pending petition for rehearing en banc before the Court of Appeals. Our response to that petition is due November 21st.
Great, thank you. When can the Ncra act on the rural district applications that utilize the expanded option from the 2016 final rule?
And I'd be happy to address that question.
Thank you.
So as you mentioned in your statement, credit unions can submit those applications now, and the Ncra will be prepared to act on those at the appropriate time.
Great, great. When can the I do have another question, though, and that is regarding the CSA applications. When can the Ncra act on those applications?
If this proposed rule is brought forward to a final rule to reinstate the combined statistical area option, then the Ncua would be able to accept and process those applications.
Okay, then, so just to be clear, does the pending litigation filed by the ABA or anything in the proposed rule change any other field of membership options and features in the chartering manual?
No, it does not. It leaves all those other options in place.
That's good to hear. Thank you. I have no other questions. Board Member Harper.
Thank you, Chairman Hood, and thank you, Marvin, Ian, and Jeff, for all of your hard work on this field of membership rulemaking flowing from the recent ruling by the U.S. Court of Appeals for the District of Columbia. I appreciate your efforts to ensure that the NCUA board acts expeditiously on this rulemaking, just as the court made clear as it is its expectation. Your thoughtful presentation today noted that the proposed rule would reinstate our previously approved combined statistical areas field of membership standard, provide further explanation of our prior rulemaking permitting a credit union located in a core-based statistical area to opt out of serving the core, and bolster the NCUA's authority to reject applications to serve community-based fields of membership if the agency determines that the proposal is based on discriminatory intent or a desire to exclude low or moderate income individuals. When considering how to vote on this proposed rule, I carefully considered two questions related to competition. The first is whether the proposed rule will expand consumer access to affordable financial services consistent with the requirements of the Federal Credit Union Act. The second, which focused on the condition of our dual chartering system, is whether the proposed rule would create greater parity in charter options between the states and the federal government. Because this proposed rule would expand access to affordable financial services for people of modest means and diverse backgrounds, and because it would strengthen the federal charter's competitiveness with the chartering regimes found in many states, I will vote in favor of the matter before us today. By law, the credit union system has a mission to promote thrift, especially for people of modest means. As such, the NCUA, with appropriate guardrails, should foster an environment that increases access to financial services for the unserved and the underserved. In my view, providing access to affordable financial services to members of modest means and diverse backgrounds is the backbone of the credit union system. However, as noted in its recent opinion, the Court of Appeals did not believe that the NCUA had adequately responded to commentators' objections that the elimination of the core requirement might allow federal credit unions to engage in discriminatory redlining. I would like to address how this issue relates to the NCUA's Consumer Compliance Program. In response to the court's decision, the proposal we are considering today would amend NCUA's regulations for community field of membership applications, amendments, and expansions for combined statistical areas and core-based statistical areas. For these fields of membership, the proposal would require the applicant, 1, to explain why it has selected its field of membership, and 2, demonstrate that its selection will serve low and moderate income segments of a community. Although this rulemaking is about the chartering process, we note in the background section of the document before us that, quote, the potential for discrimination by a federal credit union is further lessened, like other financial institutions, because federal credit unions are subject to consumer protection statutes such as the Equal Credit Opportunity Act of 1974, or Ncaa, and the Fair Housing Act of 1968, unquote. While this may be true, the NCUA has focused its examination program primarily on safety and soundness reviews for more than 3 decades. In fact, in 2019, the NCUA is on track to complete only 25 fair lending exams of more than 5,300 federally insured credit unions. Additionally, the NCUA's current method of examining compliance with consumer financial protection laws in a credit union with total assets of $10 billion or less differs from other financial institutions regulators, which complete regularly scheduled, risk-focused consumer compliance reviews and assign a separate consumer compliance rating outside of the CAMEL process for the depository institutions under their jurisdiction. To evolve and address the imbalance in the NCUA's consumer compliance program, I have called for the establishment of a dedicated and robust consumer compliance program, especially for the largest credit unions. When the NCUA board considers the 2020 budget later this year, I want to see the NCUA take the first steps towards committing the staffing and financial resources needed to achieve this goal. Such a compliance program would make the statement, quote, the potential for discrimination by a federal credit union is further lessened because, like other financial institutions, federal credit unions are subject to consumer protection statutes such as the Equal Credit Opportunity Act of 1974, or Ncaa, and the Fair Housing Act of 1968, unquote, more meaningful. And it would put our money where our mouth is. As I noted earlier, this proposed rule would also increase the viability of the federal credit union charter as compared to charters in other states, especially those states in which the laws and rules governing field of membership have expanded rapidly and significantly in recent years. Today, of the 100 federally insured credit unions with the largest potential fields of membership, only 8 are federal credit unions. The remaining 92 are state-chartered credit unions. For me, the statistical imbalance demonstrates that the federal charter has fallen behind in the desirability compared to the desirability of the state charter. The proposed rule before us would take steps to correct that imbalance. Even so, by keeping in place the 2.5 million population limit for both a core-based statistical area or a contiguous portion thereof, and combined statistical areas or a contiguous portion thereof, federal credit unions will still have smaller potential fields of membership than many state-chartered institutions. I would further note that a credit union using the narrative approach could serve a field of membership of up to 10 million people, but it's my understanding that this approach has been rarely used by credit unions since its reestablishment in 2017. Before I close, I do have one question that is addressed in this proposal, but which merits further clarification at the board table today. The comment period for this proposed rule is 30 days. Why are we providing a 30-day comment period in this instance?
I'll respond to that.
Thanks, Ian. I'm Marvin.
That touches on two themes that we're talking about throughout today's presentations. One is flexibility, the other is to act expeditiously. Congress has afforded the agency a lot of flexibility in what we do to implement the field of membership rules. Nothing in our organic statute or the Administrative Procedure Act requires a longer comment period. Often we do have a 6-day comment period, and that we did that in the 2015 proposal. But here on this rulemaking, for two primary reasons, we decided that a 30-day comment period was more appropriate. First, the Circuit Court has told us or directed us to act expeditiously.
Sure.
And second, here we're seeking comment on narrow issues that were already proposed and commented on back in 2015, 2016. Therefore, to satisfy both themes, we thought a 30-day comment period was more appropriate.
Thank you for that very helpful clarification, Marvin. And Marvin, Ian, and Jeff, thank you again for your hard work. I will support this proposed rule.
Thank you. Board Member McWaters.
Thank you, Mr. Chair. I want to remain mindful and respectful of that the matters before us today are subject to active and ongoing litigation. As Mr. Zick noted in the en banc appeal by the ABA to the D.C. Circuit Court. So given that, I will limit myself to one question, and that simply is, are the rules that are proposed today consistent with the opinion of the D.C. Circuit Court and consistent with the ruling of the D.C. District Court to the extent the Circuit Court did not modify that ruling?
Yes, that's correct.
Okay, thank you.
Great, thank you. Is there a motion?
Yes, Mr. Chairman, I move that the board approve the notice of proposed rulemaking part 701 Appendix B of Ncua's rules and regulations for a 30-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. Thank you again, gentlemen. The third and last item on our agenda today is a board briefing on cybersecurity. Staff presenting Larry Fazio, Director, Office of Examination and Insurance, and Johnny Davis, Jr., Division of Critical Infrastructure Protection, and Special Advisor to the Chairman for Cybersecurity. Welcome, gentlemen, and good morning.
Good morning, sir.
Morning.
Good morning.
And before you present, I'd like to set the stage for why I thought it was appropriate that we have today's cybersecurity briefing, not just because it's Cybersecurity Awareness Month, but because it is an issue that I really care passionately about. And one of the things I'd like to emphasize, you all, is that we need to bring fresh thinking to our regulatory approach because credit unions today are competing in a dynamic and changing marketplace. Credit unions are competing in an environment where they face challenges and threats that just a few years ago were virtually unimaginable. In this regard, cybersecurity is a concern that causes a lot of anxiety for many credit unions. In fact, as I travel around the country meeting with our credit unions, it often is top of mind whenever we do our visiting and meeting sessions. I know it's one of the things that certainly keeps me up at night. Since October is, in fact, National Cybersecurity Awareness Month, this is certainly an appropriate time for the board to have a cyber briefing, but we also recognize that we would be ongoing in keeping cybersecurity top of mind. For the federal government, cybersecurity remains a top priority. Additionally, this administration and Congress, they're all providing strong, consistent leadership on this front. To take just a few examples. In 2017, the administration issued an executive order on strengthening the cybersecurity of federal network and critical infrastructure. In 2018, the administration issued the first comprehensive national cybersecurity strategy in 15 years. Congress passed legislation to create the Cybersecurity and Infrastructure Security Agency, which the president signed into law last November. In May of this year, the president signed an executive order on America's cybersecurity workforce to provide more access to cybersecurity skills training and advanced career opportunities in the public and private sectors. These are indeed positive steps that emphasize the importance of cybersecurity. That emphasis percolates down through all of the federal agencies. At the Ncua, cybersecurity has been one of our supervisory priorities for several years now, and it will remain a top priority for the agency during my chairmanship. For example, Johnny, I recently appointed you as cybersecurity advisor, reporting directly to me on cybersecurity issues. Our initial focus is on the following: advancing consistency, transparency, and accountability within the cybersecurity examination program, stimulating due diligence for supply chain and third-party provider management within the institutions, assisting institutions with resources to improve operational hygiene and resilience, and ensuring the Ncua systems and the information we collect is secure, and sharing information on best practices for cybersecurity to assist your success in carrying out your responsibilities. As part of the various educational and awareness initiatives on cybersecurity the Ncra has ongoing this month, I've invited Johnny to brief the board this morning. Johnny, you will provide an overview of the cybersecurity landscape for financial services for our sector, for the Ncua's examination and supervisory approach for cybersecurity, and how the Ncua is working to provide related resources for examiners and credit unions. So now with that introduction to your work, Johnny, you're welcome to present. Thank you.
Thank you for having me, gentlemen. So as you mentioned, our dependency on information technology, particularly the traditional information technology as well as financial technology in the area of fintech, to include our new dependency on mobile devices that were once just phones in our pockets but are now our personal computers, travel with us everywhere, and how those services are delivered through a variety of cloud-based infrastructure organizations. All of those benefits put us in a scenario where we have increased risks and threats associated with those paths forward. And it's produced no shortage of bad actors to capitalize on those threats. This is both internal, external, intentional, and unintentional. Next slide, please. So naturally, the financial services sector is a prime target for these threats, and it's because of our rich data collection. We've got a large amount of personal identifiable information. We've got a large amount of financial business information, sensitive information, and then monetary assets in digital format. So because of this, we need to be on a heightened state of alert and vigilance, as previously mentioned. Next slide, please. Now, what's interesting about the threats, yes, sir.
Can I interrupt? Edwin is one slide ahead of you where you are on your presentation.
I'm sorry.
That's fine.
It's the Marines taking the hill here. Absolutely. All right, so on slide 3, the methods by which these attacks are taking place are pretty interesting in the sense that I can remember 20-some years ago still having these same threats: malware, malicious software in our environment, denial of services, things of that nature. What we're seeing today is additional complexity and sophistication in the sense that they're using those same methods of attacks, but adding new dynamics to them. And so you end up finding the insider being more highlighted where it used to be the external threat. Or you're finding items like ransomware that take into account several components of the historical practices. We're also finding sophistication in the sense that you'll get multiple attacks on an organization at the same time. And the first few attacks are really there to just enumerate your response to the attack taking place, where later in the scenario, you actually have the malicious payload that you're most concerned with. The root cause remains the same. Next slide, please. So the good news is we're putting a lot of additional resources into this area, financial resources by way of buying products, invested in people and processes. We should be mindful, however, that we are not investing simply because the shock and awe presented in most presentations like the one I'm doing this morning and that we see on the news and other resources that we're involved in, but that we actually have a real understanding of the effectiveness of our investment and how, in fact, we're getting a return on that investment in the security space. And I'll give some examples to this. We see a lot of areas where there's no shortage of vendors that are selling products to solve our security considerations. However, because of talent shortages or just pure understanding of the products and services themselves, we have a scenario where maybe 20% of a given solution is actually being utilized in the institution. I think this is in part due to the skill set of the folks that are available to tune these solutions. Next slide, please. So we've heard for quite some time now, particularly since 2016, of the potential shortage we were going to have in cybersecurity expertise, that by 2019 we would look at approximately 2 million jobs for cybersecurity practitioners unfilled. And while all of this is true and varies across our country, I want to point out two areas here. I don't believe that we're necessarily consistently seeing a shortage of entry-level staff. And unfortunately for myself, we're not really seeing a shortage of the senior folks, the chief information security officers and things of that nature. Where we are seeing some challenges is in the expertise in the area of what we call hunt teams. And these are the folks that actually go and look for threats that have been in our environment for quite some time. And it takes a very unique skill set to understand the lay of the land and actually find those threats. And we're also seeing this in a shortage of engineering, architecture, programmers who have the skill to reverse engineer some of these successful historical attacks and use them for predictive protection in the future. I also think we need to reassess what we think about the cybersecurity organization inside of our environment. I think there's an inherent conflict between the chief information officer and the chief security officer. One is destined to focus on IT solutions for the sake of the business, and the other is supposed to protect those. They should not be siloed, number one. So I think we need to spend some time working on the IT staff to make sure they understand that it's not just their job to, quote unquote, keep the lights on and then move to the next priority project. Someone actually has to care for continuous diagnostic and mitigation through a daily basis. And I'll talk a bit more about that in the service delivery life cycle. So how do we combat that, and what is our emphasis in this month? The critical security controls, these are a set of 20 controls that have been known to do two things. We believe that they are directly correlated to the successful attacks, almost every successful attack over the last 20 plus years. In addition to that, we believe that implementing them correctly and maintaining them correctly will actually reduce your risk by a substantial margin. However, these are typically put in place and not kept up, or not put in place completely, as I described on the previous slides. Now, you don't have to be an IT practitioner or a security practitioner to understand the concept behind these 20 controls. For example, one of the very first ones is, do you know all the assets in your environment? hardware assets, software assets. Are you aware of those? Are you aware of unauthorized assets on your network and things of that nature? These are important mom and pop components in the cybersecurity space. Once you know those assets, do you know enough about the configuration management of those assets? And we hear a lot about patching, but general, how were they configured to begin with, and how is that state being maintained on an ongoing basis? Once you put your data in there that you've classified what's sensitive, what's not sensitive, so you know exactly where data sits on certain assets, then we're concerned about who has access to that information. And why do we overly give access? Because it's an easier model to operate. So moving forward, all of these are important steps if you ever have the hopes to actually be able to do incident management effectively. So now, why are we pushing the top 20? It's not just from a compliance perspective. We do believe that it is a tailored solution that lends itself to our smaller institutions, but most importantly, it's about resilience. We do not live in the world of if you're going to get attacked. It's when, if you haven't already. And so the name of the game is rapid detection and response. And if you don't have these fundamental items in place and as a core fabric of your information security program, you reduce your ability to combat that environment. Next slide, please. So this resilience model is one of many that demonstrates the fact that if you do not have the critical security controls in place, if you have not tailored the controls to the unique environment by which you work in, and if you have not participated in information sharing groups, and two that the financial services sector focuses on quite a bit is the Financial Services Information Sharing and Analysis Center, as well as the National Credit Union Information Sharing and Analysis Organization, FSISAC and NCU-ISAL. These are two important organizations, not only for their information sharing, but really for their coordination on exercises so that you can actually ensure the effectiveness of the controls you've put in place. As we used to say in the Marine Corps, train like you fight, fight like you train. And that's exactly how seriously we need to take the exercises. It's not just a tabletop paper drill. You need to make sure that you're learning the lessons from those exercises and incorporating into the fabric of your operation. Next slide, please. Now, some organizations are doing a very good job with the critical security controls and have moved on to other aspects of the information security program. It's not a sequential scenario. You should check those on a recurring basis to make sure they're still viable. But the threat hunting, for example, is one example that we point out, particularly in the area of advanced persistent threats. The talent shortage is going to get you some very important people that you want added to your security program. And they've spent a lot of time to gain the skills that they have in place in that area. However, they do not necessarily want to work in environments where they're not going to exercise those skills. And so this is problematic because if you don't give credence to the core because you want to do the latest fancy items, the challenge with that is you leave yourself open and it impairs the ability for the higher items to take place. So what we say in this maturity model is really understand where you are collectively, not as just a hunt team, and make sure that you are growing in the model with those skill sets, bringing the junior folks along with you. All right. Next slide, please. And that leads us to the chairman's priorities that were mentioned in the opening. With that landscape laid out, I'd like to talk about our actual examination program. Next slide, please. Okay, so we've done a lot of work on maturity assessments. In 2018, we took the cybersecurity assessment tool from the FFIEC. We turned that tool into an automated cybersecurity examination tool with unique tailoring to the credit union industry. We started in 2018 with $1 billion and more asset institutions. We followed up this year with $250 million to $1 billion, and next year we plan to do $100 million to $250 million. Based on what we're learning from that process to date, we are not likely in that fourth year to continue to do maturity assessments specifically for the demographic of 100 million or less. However, these are 4-year cycles by which we do the maturity assessments, so the next cycle would continue post 2021. In between the 4-year cycle, we have incorporated the critical security controls into our examination program, and we're in the process of piloting that activity to be incorporated into our merit system. So next year, that pilot would take place, followed by the actual implementation in the following year. Next slide, please. As we promised from the spreadsheet version of the automated cybersecurity tool, we were going to automate this. And so here's a quick screenshot of that automation. We're very proud of this tool. We think its functionality is tremendous. It's also a client-server-based scenario. So you could use it in standalone, or you can use it as a client-server scenario with multiple organizations feeding into one central repository. And we're going to post this on the ncua.gov site in 2020, free to our institutions. Next slide, please. Now, our training. We're a smaller, more agile organization than some of our financial services counterparts in the federal space. So we pride ourselves on making sure that every examiner at NCUA receives some introductory training to information technology and cybersecurity. That's when they first come on board. Approximately 2 years after they're on board within the core structure, we give them an increased level of training to include additional activities within our tool sets. By the time they are selected to be a subject matter examiner focusing specifically on IT, we have an increased array of training that they receive to include on-the-job training with our specialists that we call regional and national information systems officers. And those folks are typically our strongest cybersecurity practitioners. They have the industry standard certifications and things that you would expect and see in the institutions, and participate in the conferences with the rest of the federal regulators. Next slide, please. Now, that's our current position. We want to increase and continue to maintain their skill set. So we have adopted the National Initiative of Cybersecurity Education by DHS and OPM to make sure that we have specific categories and specialty areas for career ladder training throughout their tenure in NCUA. Next slide, please. So supplier risk management. The due diligence that we want to focus on, and it stays with the theme of providing resources to our institutions, is along the fact that we know this is a challenge. And as we've built up in this slide presentation, it's a challenge. However, we need those resources. Credit union service organizations and other third parties are going to be absolutely essential to our smaller organizations being able to compete in this cyberspace. So by way of support, we believe that we can make sure that there's some standard contract acquisition language, that there are service level agreements with very specific outcomes from an operational and technical perspective, that key performance indicators and risk indicators are identified with examples of what those look like in an operational status, as well as incident management to make sure that you are getting notified promptly to take care of your responsibilities to your consumers. Next slide, please. So again, our focus, Ncua has its webpage for cybersecurity resources. We also have some information that we put out collectively with our FFIEC counterparts earlier in the year. And I would like to give a real world example of how we believe this is the most important thing we can do beyond our examination activity. We met with an organization, Larry and I, a few weeks ago, and they were explaining the challenges they were having per state of actually identifying who the law enforcement folks were that would address a cybercrime. And it's an interesting environment as far as who has jurisdiction over a specific crime and who has the interest and who has the resources to address that. So we immediately went back and did some research on how can we help out with this problem, and actually found a resource that had every law enforcement cybercrime point of contact for every state. And we want to get this posted on the resource site. Okay. And so how we're moving forward to make sure that happens, and this is my last slide, I wanted to point out the fact that Larry and I certainly don't do this alone, even within our teams. We are partnered with our Chief Information Officer's office and the Chief Information Security Officer. Our General Counsel office has our Privacy Officer. We've got our CURE office that focuses on small disadvantaged organizations, and we've got our Consumer Protection Group that also has a cyber play. And so just this week, our executive director approved within our cybersecurity steering committee the ability to put a working group together to make sure that while we already have these resource pages, that they are kept up vigorously. All right. And that concludes my presentation, gentlemen. I'll answer any questions.
Great, thank you. I just want to ask, you've given us a lot of information today.
Yes, sir.
What, if any, one thing which you want credit unions to have as their main takeaway this morning from your robust presentation?
Thank you, sir. My main takeaway is please do not confuse this presentation as the be-all, in the sense that if you do critical security controls, you're taken care of. But if you're worried about where to start, and this is too much to grasp all at once, start with the critical security controls. If you've already progressed past those critical security controls, never lose sight of how you're doing in those areas. They will come in handy when you need it the most.
Great, and I want go ahead, Larry. I was just going to say, I'd like for the industry to know that I have tasked Johnny with not just presenting before us this morning, but also doing newsletters and webinars, and also speaking at some of the trade events and some of the credit union events and things of that nature. He is a resource that I really want to go beyond the doors of 1775 Duke Street, because I look at the resources he can provide you as being invaluable to your ongoing success. So I just want you all to know that. So you're hearing from him today, but there will be other opportunities to glean insight from the great work he's doing with the other stakeholders here that he mentioned from Ncua. Another area that I want to just discuss, and just briefly before I turn it over to the fellow board members, can you elaborate a little bit more on the role that our examiners are going to play going forward in examining for cybersecurity, and then separating that from the role of some of the specialists that you've mentioned?
Yes, sir. So starting with the specialists, naturally, we have the information system officers that focus on cybersecurity and IT examinations across the board. That is their primary role, and they're educated and experienced in that area and will continue to do so. The IT subject matter experts or examiners that I mentioned, they are financial examiners with a specialty area of IT cyber, but they utilize that area at approximately 20%. So they assist the information system officers in that capacity. Courtesy of the maturity assessment process, and particularly with our smaller organizations, we are starting to leverage the generalists by way of the training that we described here today, with oversight of the IT SME and the NISO community.
Could you tell some of the folks what those ZOs are?
I'm sorry, sir. So the National Information System Officers, which are typically our larger credit unions out of the WANS organization, and our Regional Information Systems Officers that are in the field.
Great, thank you. I have no further questions.
Yes,
Board
sir.
Member Harper.
Yes, sir.
Thank you. I do appreciate the spelling out of acronyms. And Johnny, thank you today for your overview of the cybersecurity landscape. And Mr. Chairman, like you, I am deeply concerned about the increasing exposure of our financial system to cyber attacks, and it is also one of my priorities. Malware, ransomware, distributed denial of service attacks, and other forms of cyber intrusion affect financial institutions of all sizes and will require ongoing measures for containment. Credit unions, their vendors and service providers, and the Ncua need to work proactively to protect against cybersecurity threats. Because cybersecurity is one of my priorities, I am pleased that the Ncua is working diligently to mature our cybersecurity examination program by advancing consistency, transparency, and accountability. That we are also working to stimulate due diligence of third parties within the credit union system, that we are supporting credit unions with training, informational resources, and grants aimed at improving operational preparedness and resilience, and finally, that we are ensuring the security of the Ncua systems and collected information. Johnny, as you noted during the briefing, the threat of cyber attacks is rising, and the financial institutions like credit unions are increasingly vulnerable given the target-rich financial and personal information that they hold. Edwin, would you go to slide 5? On slide 5 of this deck, I see that more than on the left-hand side, top row, third column, that we have more than 1 in 4 organizations have experienced an advanced persistent threat attack. And did I get APT right, advanced persistent threat?
Yes, sir.
Okay. That 1 in 4 organizations have experienced such threats, but I'd like to know whether we have more detailed statistics for federally insured credit unions. What is the actual credit union experience with cyber attacks? Is it 1 in 3, 1 in 2, or is it even higher?
Unfortunately, sir, I'm not prepared to give specific information on the APT threat within the credit unions. This slide was to represent the fact that we participate in a global community where this exists and the likelihood is high because of our target-rich environment. Currently, we also typically receive reports from credit unions on catastrophic events and incidents that have been deemed to adversely impact consumers. Mm-hmm. While we find incidents within the examination process, we have not correlated them all together on APT. And I think it's important to understand that APT in itself means an attack that has been persistent in your environment, though you have not discovered it.
Okay. That's very helpful. And when I think back to earlier, one of your slides noting that financial institutions were target-rich, given that it's 1 in 4 overall, it wouldn't necessarily surprise anyone if we were actually at a higher ratio overall.
I would not be surprised by that.
Okay, so credit unions need to be aware of what's happening and take proactive stances.
Absolutely.
You started to answer a question that I wanted to ask that the chairman actually made me think about. What are the 3 most important things a credit union could do to improve its cybersecurity readiness stance?
It varies on where they start, so let's begin there. Taking the risk assessment seriously, okay. Making sure they truly understand their IT risks, both from an inherent risk perspective and from a residual risk perspective after controls are put in place. And when they're considering how they move forward, don't discount the inherent risk condition, because if all controls fails, that's the condition that you're going to operate in. So I think that is the most important item, followed by the critical security control implementation. And as I mentioned in the presentation, rapid detection and response. One of the biggest problems we find is how long have you had data exfiltrated out of your environment because you didn't know the attack exists. So knowing what normal means for you and quickly identifying what's not normal is important.
Johnny, that's a terrific answer, and I know that you're going to be ramping up communications. I would love to see that get communicated to the credit union community, because I think it would do a great deal to improve readiness, if you agree, Mr. Chairman. Johnny, also on this slide, you were talking about that we have too few professionals. In particular, you were talking about the need to do cybersecurity safaris and going out and hunting down people. I'm a little more interested in knowing how we stand versus our other federal financial institutions regulators in terms of cybersecurity policy staff. Are we on an even footing? Should we commit even more resources to that area?
I'd say within the past year, we were not on even footing. My office had 2 full-time staff and myself. The office was just really formalized last year to work with our other financial resources in the federal community, as well as participate in the exercises that I just mentioned are so important to applying lessons learned across the board. We also typically are outnumbered in the sense that we're at an event this week where our counterparts are 20-1 in their participation in that activity. Now, there are a lot of extra considerations that need to be factored in. You all, our leadership, has given me some new resources that we are actively pulling on board. We've got a new hire coming in 2 weeks, and another announcement that we just received from OHR this week. So we're progressing, and I don't think we want to jump too far ahead of pushing a lot of resources on this. I think what we want to know is the caliber of resource and how smart our process is in order to get more out of that. For example, some of these exercises have the exact same focus. So is it more important that we are at every one of the 20 exercises, or are we at the 3 that have the most unique criteria that we can leverage across the program?
And Johnny, I very much appreciate your answer. I think it is a balanced approach and a measured approach. And what I'm hearing from you is that we do need some more resources. We have been providing some more resources to this area. Right. We could probably use a little bit more, but that we also have to really take a look at the world around us, and let's not make sure that we're overstaffing and overcommitting to efforts that have only a marginal value for us. I certainly would be supportive if the budget came forward with increases for cybersecurity policy staff. Finally, as I understand, cyber criminals are focusing more and more on smaller institutions' websites and supply chain networks. Accordingly, I'm a strong supporter of the Ncua having the authority to examine credit unions' third-party vendors and credit union service organizations. In contrast to other financial institutions regulators, the Ncua currently may only examine QSOs and third-party vendors with their permission. Without vendor authority, the Ncua cannot accurately assess either the actual risk present in the credit union system or whether the risk mitigation strategies of QSOs or third-party vendors are adequate and can effectively protect our system from a propagated risk. The Government Accountability Office and the Financial Stability Oversight Council have both repeatedly called on Congress to close this regulatory blind spot, and I very much agree. As such, last week I was pleased to read a discussion draft of legislation in the House of Representatives that would provide the Ncua with vendor authority. In discussions with the Ncua staff, I understand that we should request some modifications to this draft legislation to reflect the unique nature of the credit union system, but the concept in this proposal is a solid step forward toward giving the agency the tools that it needs to better protect the credit union system from cyber threats. I'm hopefully that the board will be able to come together to send a letter to the bill's sponsor expressing our support for moving forward on vendor authority legislation, in addition to requesting changes to the legislation to address the credit union system's unique needs. In that respect, Larry, would you outline what the gaps are in Ncua's supervision program that have been created by a lack of vendor authority and why they are material?
Which I think I'm going to let Johnny go first on that, and then I'll fill in.
Okay.
So I think, as we mentioned, we have a unique dependency on third parties. Our smaller institutions cannot do this cyber work on their own. And so once they have to leverage the CUSO environment and the other third-party environments, they find themselves typically having very minimal influence in getting the vendor to participate in the cybersecurity activities that they need to be successful. And that's not unique to the smaller organizations. I've seen larger organizations who have challenges getting some of the bigger vendors to participate in really letting us understand how they are addressing our cyber concerns. I couch this in a fairly long answer here because we can give responsibility to our third-party partners, but we cannot give accountability to those partners. So the consistent approach that here's the service I'm offering you, please continue with that. No other customer has asked us about what you're asking about and things of that nature. We hear that as recently as this morning. I think the smaller institutions are going to need some assistance from a partner who actually has the ability to speak for the larger industry.
You could also understand how, as a vendor who's providing core data processing and all of the now ubiquitous proliferation of the Internet of Things and the technology and the technological way of delivering financial services, those vendors that are supporting all that and providing all of that, which cranes are increasingly depending on, you can understand from their perspective why they also might not want to be completely forthcoming with some proprietary or what they would view as very sensitive or confidential information for clients. In our role as a government agency, like with credit unions, when we examine them, we have the confidentiality aspect of that. It's that inherently governmental aspect. And so our ability to have better insight into the cybersecurity controls that those vendors have in place and how that intersects with the credit union's cybersecurity risk and the vulnerability of their consumer member data, how that all plays out, our ability, like the banking agencies have, would be enhanced by having that direct authority, of course.
And I appreciate all that, Larry. And the second part of my question was whether there was a materiality. I mean, is this a real exposure? Could this be a substantial exposure?
Oh, sure. We've got vendors who have thousands of credit union clients that that have a significant nexus to cybersecurity and member data for those client credit. Hundreds of credit union clients. So you can imagine the scope and scale of something that could happen through that process.
We've estimated approximately 5 of the core processor vendors own approximately 85% of credit union business.
5 own 85%.
Absolutely.
Wow.
And so when you look at the fact that the bad actors have actually gotten smart about this, why go look for 100 credit unions and attack them individually when I can concentrate on the source of most of their services?
Thank you for that.
I'd add one other dimension. To the extent that those vendors are also serving banks, and to the extent that the product line that they're serving cranes and banks with are the same, we do get comfort from the fact that the banking agencies have the vendor authority and examine those entities, do reviews of them, and we do at some point get those results shared with us. But we have vendors that are almost completely credit union centric, where they are not being evaluated by the banking agencies, and there's a definite gap there.
There's a gap there, sure. Larry, I know that you've testified on this issue previously. Would you explain how giving the Ncua vendor authority would provide a measure of regulatory relief for credit unions?
So the way I would think about it is I would call it a net positive benefit for the credit union system. Obviously, the vendors are going to view it as additional burden, right? We're going to examine them. Maybe, again, if they're one of those credit union only or credit union predominantly vendors that aren't getting examined by a banking agency or us, that's an additional burden for them. But the net positive good we could do collectively for the system, I think, is a net positive. to Johnny's point, instead of us trying to go through 100 different or 1,000 different credit unions to figure that out, we can go right to the source if we had that authority in an efficient and probably more effective way. Because again, the crane isn't necessarily going to have access to that proprietary or confidential sensitive information that the vendor would rightfully not want to put out into the wild. Because then if the hackers got a hold of that, then they could use it against them. So I view it as a net positive benefit, and but that's additional government, obviously, access.
No, and I appreciate that. And the way I've likened our current authority in this area is that we can ask for the books, we can knock on the door, we can look in the window, but unless they open the door and allow us to come in, we can only get so much information. Regardless of whether Congress acts on vendor authority, financial institutions of all sizes must take a strategic risk management approach, which includes continual hardening and improving the security of their networks, as well as a thorough review and mitigation of risk with their respective supply chains. And the NCUA has an obligation to strengthen the readiness of credit unions to respond to cyber threats through our supervision, training, outreach, and grants. As such, I will continue to make these matters a priority for my work on the NCUA board. Thank you again for this important briefing on cybersecurity. I'm hopeful that we might be able to have another one in about 6 months to learn about the progress the agency and the credit union system have made.
Yes, sir.
Sounds good. Thank you, Board Member Harper. And regarding your idea of the board letter, as you are likely aware, I have a number of congressional letters these days that warrant my attention. So I will certainly welcome the opportunity to follow up on that request.
Thank you.
And regarding vendor authority, you all, I'd just like for the industry and the stakeholders in this room to know that we as an agency did in fact have vendor authority many years ago, leading up to Y2K, and then it sunset. So as we position the agency and looking at vendor authority issues, it's not a matter of us getting it for the first time as if we've never had it and did not know how to use it judiciously. It is a matter of what I would believe is looking at it being reinstated, redelegated, but not, and stakeholders leaving this room thinking we've never had it before. With that being said, Board Member McWaters.
Thank you. Let me see if I can get to the bottom line on the vendor authority issue. Cybersecurity breaches, to me, present a safety and soundness issue to the credit union community and to the Share Insurance Fund. Everyone is telling me that the NCUA having vendor authority would lessen the safety and soundness risk to the credit union community and to the Share Insurance Fund. But let me take this a step further. What does safety and soundness risk mean? What it means is if there is a cybersecurity breach and it's material and the NCUA has to write huge checks out of the Share Insurance Fund, guess who gets to repay those checks? Members of the credit union community. So my view to the credit union community, trade associations, anyone who's on the Hill is to say, vendor authority for the NCUA is in my personal best interest if I'm a credit union, because I don't want to write any more checks to the NCUA because of a cybersecurity breach that was caused by lack of vendor authority that every single other banking agency has. Thank you.
Thank you very much. And again, I just want to reemphasize, cybersecurity is indeed one of the top risks facing America and the financial services industry. We are clearly in the midst of an information age where technology and cybersecurity have become an integral and ubiquitous part of financial services. The advancements in data and technology have generated vast benefits and efficiencies. However, they have come with emerging risks and threats. It is essential we strike the right balance between innovation and security. The ability of credit unions to safely and securely use technology to deliver member services and adopt financial innovation will be essential to the industry's long-term success. So thank you, gentlemen, for the role you play in helping with that long-term success. There being no other business to discuss this morning, this meeting is adjourned. Thank you.